It's basically the planning, organizing, and control of financial activities and financial resources. Okay? Whenever you hear the word management or managerial attached to something, always remember the functions of management: planning, organizing, controlling. So here in managerial finance, which can also be called financial management, it's based on planning our financial resources. Our financial resources can be money, it can be our assets. Organizing these financial resources, remember, to plan is to think ahead. Okay, you think ahead, make goals and objectives, and then you strategize how to achieve those goals and objectives. Alright. Organizing just means you're bringing things together and making a structure. Okay, putting things in order. Okay, so organizing of financial activities and resources. Then control is to make sure that your plan is going accordingly. You're making sure the goals and objectives that you set, you are achieving them. Okay. Now in this case here, these goals and objectives are based on financial resources and financial activities. Next, the role of the director of finance for a company. Okay. Number one is financing decisions. Where is the money coming from? That's what financing decisions are. Where is the money coming from? Are we going to sell shares? Are we going to sell corporate bonds? Alright. Are we going to get a loan? Okay. Are we going to use our retained earnings, the profit we've been making, which we've kept? Okay, those are part of the financing decisions. Okay, you've got budgeting and cost control. So a budget is all about seeing your cash inflows and your cash outflows. Okay, whenever budgeting is all about planning, colleagues. Alright, so every year your companies are going to make a budget. This is the money we expect to come in. These are the expenses we expect to incur. Okay, so you always want your actual activities to be at least in line with the budget. Okay, in terms of expenses, you want your expenses to be in line with the budget or even less than the budget. Then your revenues, you would want them to be more than your budget, because it means you've done better. Okay. Yes. Then we've got investing decisions. Okay. Deciding where to invest the money for the company, which is called capital budgeting or investment appraisal. Okay. As a company, you want to grow the value of the company to grow. You want to expand the company, you want to have new factories, new equipment, better technology. Okay, so this is where the investing decisions come in. Okay, the company is deciding where we're going to invest our money. Then we've also got deciding the capital structure of the company. Capital structure is just how much equity financing or how much debt financing the company is going to use. Okay. Each of these types of financing have got the advantages and disadvantages. Equity financing is through selling shares. Okay. You sell shares, that is ordinary share capital, the money raised from selling shares. Okay. To an investor, okay, if an investor sees a company uses more equity than debt, that's a good sign, because it's saying the company is using more of its money to fund its operations, okay, and invest in certain things. Okay. But if a company is utilizing more debt than equity, it means it's utilizing other people's money, borrowed money. Okay. So each of these come with their risks, because like debt, the more debt you get as a company, the more interest payments you have to make. You run out the risk of failing to pay those interest payments, or even paying the loan back. Okay, solvency. Solvency is about companies being able to pay their loans. So the more loans you take, this risk grows. Okay, because you might not make a profit that year, and you have to pay the interest for the debt. Okay. Yes. So deciding the perfect working capital structure, the perfect capital structure for a business is a very important decision. Alright. You cannot use 100% also equity financing. Okay. It will be impractical. Okay. You have to have a mix of debt and equity. Okay. So the preferred models, at least you have more equity financing, which is your own money, than debt financing. Okay. Depends also. It's also dependent on the business that you are doing. Okay. Not all capital structures are suitable for every type of business. Performance evaluation, especially where you will be using financial ratios, you want to see how well the company has performed in terms of profitability, ability of the company to make profits from its operations. And also evaluate it in terms of liquidity. Is the company able to pay its bills on time? Liquidity is all about converting your assets into cash, okay, so that you can pay your bills. Okay. You also want to evaluate your company on efficiency. How well is the company utilizing its assets? Its inventories, receivables. Okay. So there are many areas you would want to evaluate the company. Okay. Then you've got working capital management. Okay. Working capital, this is the money that is used for the day-to-day running of a business. Okay. So you can also think about working capital management as the management of current assets also. Okay, because working capital deals with inventory, cash, your receivables. Also, it deals with your trade payables. Okay, so these four things, you have to manage them well, so that your company is profitable and your company is also liquid enough. Because working capital management is trying to ensure the company is profitable and liquid enough. Okay. Shareholder wealth maximization, which I would say is one of the most important goals of any company, especially this public limited company. Okay, shareholder wealth maximization, basically increasing the overall value of a company. Okay. Also, shareholder wealth maximization, you're paying, because remember, shareholders are the owners of the company. Okay, so shareholders get dividends, so they earn more wealth if they're getting paid their dividends. Okay, and also if the value of the company increases, the share prices also increase. Okay, so the shareholders can sell their shares for a profit. That's also part of shareholder wealth maximization. Okay, when the company grows in value, it can pay out dividends to make the shareholders happy, and also share prices will increase. So these shareholders, if they want to resell these shares, they can make a profit. And then deciding on dividend policies, how much profit to pay out as dividends and how much to keep. Okay. On the investor's side, okay, if a company is rarely paying out dividends, it better be investing that money for something. Okay, because people want to invest as shareholders, they're going to want to dividends. So So a company that pays out dividends looks attractive to potential investors. Okay? So it doesn't also mean every year you have to pay out dividends. Sometimes you can keep that money, but it has to be for a good cause. It has to grow the value of the company. Okay, colleagues. And these are the three major financial management decisions, okay? Investment decisions, okay? Because this eventually is going to grow the value of the company. Okay, where you buy new equipment, build new factories, get new technology, okay? Your company will grow in value. Okay? Financing decisions, okay, where the money is coming from, okay, and also these dividend decisions, what to do with the profits, because all in all, these three are going to have an effect on the value